Hello everyone. Welcome to the Edgemoor Investment Advisors second quarter 2020 current market conditions and outlook. I'm Jordan Smythe and I'm here again today with my colleague Gay Truscott. And we're still, of course, working from home, now in our 5th month of doing so. The transition has been remarkably smooth so far, though we're certainly going a bit stir-crazy in our home offices. We're still available by phone or email, of course. And we've also been using Zoom, as I'm sure many of you have as well, for our regular investment committee and staff meetings. We are really looking forward to being able to safely return to working together in our offices, but we're pleased to report that we've been able to carry on our work on our clients' behalf in the meantime. We hope you are safe and healthy in these strange and challenging times and are able to do something fun to break the monotony this summer. And we appreciate your joining us now for this presentation. We're going to share some observations and our outlook with you, but first we want to acknowledge up front that things are still changing rapidly with the COVID-19 pandemic and its impact on the global economy. We've learned a great deal, certainly over the past few months, but there's still much that we just don't know right now. I'm going to start us off by providing an overview of the stock market's recovery in the second quarter. Gay will then discuss our outlook and thoughts on our portfolios. The summary of our current view on the markets is that we remain optimistic that over the long term, the U.S. and global economies will survive the current challenges and return to the steady expansion that we were seeing into the beginning of this year. However, our near to intermediate term outlook is more muted due to our concerns about the ongoing effect of the pandemic, including the potential for a second wave in the fall, depressed consumer purchasing, and delayed rehiring of the remaining workers furloughed or laid off earlier this year. Let's start with a review of the second quarter. After a brutal decline in March, the stock market had its best quarter since 1998. As you can see in this chart, the S&P 500 index rose just over 20% in the quarter and was up 39% from the low point on March 23rd. By the end of June, the market had recovered enough that the S&P 500 index was down only 3.1% for the first 6 months of the year. Quite remarkable, in our opinion, given the challenges. As you can see in this longer-term chart, stocks are now trading near their all-time highs, which is good news for investors, but it also is a condition that gives us reason to be cautious, as Gay will discuss in detail. Many of the consumer cyclical stocks, such as those in the travel and hospitality industries, recovered strongly, partly due to direct support they received from the government. Energy companies also rebounded with the price of oil, which had fallen in the first quarter due to decreased demand resulting from the shutdowns due to the pandemic, and also an oil price battle between Saudi Arabia and Russia. Tech companies have been the real stars of the first half of the year, as they have proven their ability to provide for the needs of customers in the face of the economic shutdowns. Their shares have risen sharply this year and have taken the tech-heavy NASDAQ Composite Index to record highs. There are a few reasons for the sharp recovery. First and foremost, COVID-19 remained the fundamental issue. As you can see in this chart of new cases of COVID-19 in various countries, China, Europe, and the United States all made steady progress during most of the second quarter in reducing the number of new cases and deaths from the spread of the coronavirus. This red line in the middle represents the United States. You can see the decline in new cases through about mid-June. Social distancing and the shutdowns of portions of the economy seem to be having the positive effect that we had hoped for. However, the trend changed significantly toward the end of June, with new cases surging across the country, particularly in states that had moved quickly to reopen their economies. Another positive factor, though, during the quarter was the aggressive action by the U.S. Federal Reserve and also Congress to provide relief to workers and businesses who were harmed by the government-mandated shutdowns of much of the economy. Finally, as many states began to reopen their economies after the shutdowns, businesses rehired in May and June about a third of the 22 million workers who were furloughed in March and April. And as a result, the unemployment rate dropped to 11.1%, significantly down from the peak it hit in April, but still higher at 11.1%, even than at any point during the financial crisis. While the support from the government and improvement in the job situation certainly helped, there were major challenges in the second quarter that we still face as we begin the second half of 2020. Government mandated shutdowns of schools and businesses in response to the pandemic sharply reduced economic activity, and most of the workers affected remained on the sidelines. Gross domestic product declined 5% in the first quarter, and likely much more in the second. Similarly, corporate earnings plunged 15% during the first quarter and likely fell 45% in the second. If not for the aggressive and decisive actions by the Fed and Congress, which we certainly applaud, the economic and market statistics would have been much worse, and the market's rebound would likely have been more muted. I'll now turn the presentation over to Gay for a discussion of current conditions and our outlook.
Thank you, Jordan. I'm going to share with you some of our mid-year observations, our outlook for the remainder of 2020, and the implications and actions we are taking for client portfolios. As Jordan mentioned, this pandemic and the global economy are still in a very fluid state. Having said that, we do see economic conditions starting to improve in the U.S., particularly as compared to the March-April timeframe when the government-mandated lockdown plunged the U.S. into the sharpest and fastest recession in modern history. But while many economists believe that the low point has now passed, which is evidenced in the U.S. by the net addition of 7.5 million jobs in May and June that Jordan previously mentioned, it is still the case that the timing, the pace, and the nature of the economic recovery remain highly uncertain. In contrast, the stock market's rapid rebound, beginning in the second quarter, has been a bit of a surprise to most of us, and honestly feels disconnected from the economic challenges we still face. But of course, this is not the first time that Wall Street and Main Street have been at odds, and it probably won't be the last. Some of the disconnect can be attributed to the powerful monetary and fiscal stimulus from both the U.S. and foreign central banks and governments that have provided critical and unprecedented support to the global economy and helped dampen the economic blow from the pandemic, as well as driving stock markets higher. But again, uncertainties remain, as we know much of the consumer stimulus here in the U.S., most notably the supplemental unemployment benefits, will expire at the end of July unless Congress acts to extend it. Moving on to our outlook. We now have greater concerns about the market's prospects for the coming quarters than we had previously, so our outlook can be best described as muted. The United States is once again having difficulty controlling the spread of COVID-19, and there is renewed uncertainty about the rehiring of furloughed workers and the reopening of schools and businesses. As a result, it is likely that the U.S. GDP and corporate earnings will remain weak in the coming quarters. Also unknown is whether our political leaders will provide another round of financial relief to workers and businesses. We are hopeful, but the highly charged and partisan climate could make relief measures harder to deliver before the November election. All in all, we believe the stock market will remain volatile until many of these uncertainties are resolved and the prospects for a vaccine become clearer. In terms of portfolio implications and actions, we continue to take a cautious stance. We are currently holding higher levels of cash than normal in client accounts, as we sold certain holdings early on that we believed were most directly exposed to the impact of the pandemic. We remain poised and ready to take advantage of opportunities to redeploy this cash as individual securities become available at attractive prices. But it is likely that we will hold higher than normal cash levels in the near term, again until there is more certainty regarding the trajectory of the pandemic and the recovery of our economy. Similarly, for the income portions of portfolios, we are also being cautious and currently favor less volatile securities such as bonds and preferred stocks. As always, we continue to believe the best course of action for investors is to stick with a long-term buy and hold investment strategy. We believe that high-quality companies with durable business models and sustainable competitive advantages, like the ones we own, will survive this temporary threat and deliver solid, long-term returns to patient investors. Now more than ever, we believe that selectivity, active management, and patience are the keys to long-term investment success. Now I will turn it back over to Jordan for some closing comments.
Thanks, Gay. These are very uncertain times, and we understand the anxiety caused by the pandemic, its disruption on our daily lives, and the resulting economic and market downturn. We remain confident in our investment strategy and our long-term focus, are monitoring the situation closely, and will continue to adjust our portfolios as we see the need and the opportunity to do so. We hope you are staying safe and healthy, which is the most important thing for us to do to help get things back to normal, hopefully sometime soon. Thank you for taking the time to join us today. We hope you enjoyed this presentation, and we welcome your questions, comments, or suggestions. Take care.